Welcome to Transaction Preparedness, Resilience, and Innovation. This session is presented by Rivers Agile. Let's meet our panelists. Please welcome Joe Slezak. Joe is the Director of Marketing and Business Development at H2R CPA firm. Also meet Ben Garber. He's the Vice President of 7 Mile Advisors. And the moderator for this panel is Ben Wilson. Ben is the President and CEO of Rivers Agile. Ben, take it away.
Okay, thank you for that introduction. Welcome to the Transaction Preparedness session. In this session, our CEOs and M&A experts will discuss valuation, development, and adaptability, and how that preparedness can mean the difference between growth and stagnation. First, let's meet our panelists and take a deeper dive. As mentioned, my name is Ben Wilson. I'm the CEO and founder of Rivers Agile. We are a local Pittsburgh-based technology consulting company. With me is Joe Slezak.
Yeah, thanks, Ben. So, name's Joe Slezak, as referenced, Director of Marketing and Business Development for H2R CPA. H2R CPA is a regional accounting firm headquartered in Western Pennsylvania. We work with a variety of businesses, both small and large, across a variety of industries. But in the mergers and acquisitions sector, we primarily work with the lower middle market. I also sit on the board of directors for the Pittsburgh Venture Capital Association, and I am a executive committee member of the Great Lakes Capital Connection, which is an awesome deal sourcing networking event that occurs every year in September.
Thanks, Joe. Ben Garber, welcome.
Ben, I'm glad to be here, and thanks for having me. 7 Mile Advisors is a mid-market investment bank representing founder, family, and management-owned companies in M&A and growth capital transactions. 2021 is looking to be a bright year, and I'm looking forward to discussing it with you.
And we're going to expand on that topic heavily during this conversation. One note, Joe Slezak mentioned the Pittsburgh Venture Capital Association. All three of us have ties, either current or former, to the organization. I know, Ben, you served as the chairman of the Emerging Leadership Board, and Joe and I are current board members. So let's first start off. Let's talk about the 2020 business landscape for these closely held businesses that are represented here today. I would argue that for most people here, 2020 was the hardest year to be a leader for an organization. I know I would argue it certainly was for me. And it's not over yet. But you have to pivot. And one of the ways that we pivoted as an organization is we sought out and responded to modified buying patterns from our customers. There is no business that has not been impacted by the pandemic, and buying patterns do change as a result of that. And so we had to morph and pivot and really answer what our current client needs were and then respond to them. Another item is reevaluating your expenses. Your expenses for 2019 versus 2020 are far different. Certainly office expenses are down, right? But also what you're investing in, and are you investing that money for the short-term or the long-term success of your company? Also revisiting your forecast. Many organizations have flattened their forecast for the first half of 2021. And that's right, because we still don't have all of the answers. We don't know what the business climate will be, but we do think and see that it's starting to thaw. As a tech company, I would say that we were better prepared to transition to a work from home capacity than others. Certainly, there are plenty of other organization types that had a much bigger challenge to adapt to that work from home policy. Joe Slezak, tell us what you saw.
Yeah, what a mess, to put it bluntly, right? It was chaos. And as an accounting firm, we saw it firsthand, right, with all of our clients. Mm-hmm. And all of us on this phone or this meeting saw it as well, right? In a 24-hour period, the entire economy was shut down, right? Talk about the ultimate stress test that could probably happen in one fell swoop. But the big story coming out of 2020 from our perspective probably was the PPP loans, right? That was something that had never existed before. And and the government realized they had to do something in this unprecedented time. But it was interesting. And in some regards, it's not completely over, right? Because now there's the second draw PPP loans that people are able to apply again, depending on their current situations. But it was interesting because it was rolled out so fast, and it had to. And our firm, we always talked about the spirit of the law, right? What was the spirit of the law? But the banks are telling our clients to ask the accountants, as accountants were reaching out to our banks, asking how we should advise our clients. And no one had any answer because there was no answer. It was a brand new program. It never existed before. Everyone was just trying to figure out how to survive and how to get their employees paid and to just get through 2020. Ben, as you referenced, thinking at that stage that this was going to somehow end in 2021, instead it just kind of carries over into another year. But I think it'll be interesting to see how it unfolds for a lot of industries over the next 3 to 4 years. Because realistically, there are some industries that have done very well, pivoted as you referenced, and probably had some of the best years ever. Ben would argue that you probably should talk to him soon. Ben Garber, that is. And then there's a lot of industries that they're not predicting the return for 3 to 4 years. My personal question, I'm curious how commercial real estate unfolds, right? As you referenced, Ben Wilson, a lot of people had to pivot and work from home. If you read some papers, they're saying people are going to return back to the office. It's probably going to land somewhere in the middle. Even if it lands in the middle, that's going to disrupt the commercial real estate market, in my opinion.
Absolutely, Joe. I think that's a question that is yet to be answered. I could tell you that Rivers Agile opened a beautiful new office in downtown March 16th of 2020. So you could not have any better timing than that. And now, of course, we're rethinking how will we use this investment in commercial real estate. Great. Thanks, Joe. Ben Garber, I think a lot of attendees are wondering about this. What are you seeing with the current deal landscape? And what is surprising you?
Yeah, absolutely, Ben. It is a robust time for M&A activity. And for a lot of business owners that I speak to, that's counterintuitive. Reading the newspaper today, you'd think it'd be a horrible time to be doing a deal. And who could possibly be out doing acquisitions? And the answer couldn't be more of the opposite. We are seeing heightened activity at valuations above pre-COVID levels at increasingly seller-friendly terms. There's a couple things leading to this. One is a deluge of buyers coming back to the table. In the heat of COVID, some portion of the buyer landscape was taken off the field. Whether this was private equity firms who were reliant on high leverage multiples, so think 6 times EBITDA on debt, which is now more like 4 times. You had strategics and private equity who saw their revenue go to zero or near zero, especially deemed non-essential businesses, had to buckle down and focus on operations. And then you had corp dev officers who lead M&A for large corporates who are getting told by their boards and executive leadership, this is a great opportunity for us. We're well capitalized, get in there and do some deals. But these officers still knew they had to go back into an investment committee and underwrite a forecast on a combined basis. And these corp dev officers were telling me, we can't even forecast our own business 6 months. How am I going to forecast a business combination?
Sure.
So a lot of that has now stabilized across industries. And quite frankly, you have buyers coming back to the table trying to make up for lost time. On the seller side, some businesses have seen stability come back, customer schedules are normalizing. They're at least able to look out over the year, get a good sense of what the COVID impact actually has been, and start planning for the future again. And quite frankly, many of our current clients are entering the market in response to proactive outreach from buyers.
Interesting. Really interesting. My prediction would have been that there would, the back half of this year would be ripe for businesses and deals being done that had COVID discounts. But you say no.
No such thing as a COVID discount. We never saw it. In fact, buyers have been bending over backwards and going through quite extraordinary gymnastics to adjust out any COVID impact. Now, the flip side of that, if you received a COVID bump and can't substantiate why that bump is going to last, that's also being normalized out. But on both sides of the table, buyers and sellers have been pretty cordial in ring fencing, identifying, and normalizing out any COVID pricing deals largely on the 2021 forecast.
That's interesting. So a bump, a COVID bump, we'll call it, if it falls in line with maybe a 5-year history of steady growth, no problem. But if it's that you can't justify, or frankly are scratching your head as to how it happened, you may have to justify using that.
The best example I have is a company that previously did not sell masks and then sold a bunch of masks.
Oh, that's interesting. I think I bring a pretty interesting perspective here as an owner and as a CEO. You know, I have obviously a high tech lens that I see the world through, right? And what I could tell you is our current clients and new clients, one of the biggest themes that I'm seeing is help me use software, help me tie things together so that I can get actual actionable data to run my business, right? One thing I think a lot of leaders have seen is this landscape has changed, and my old approach to running this business does not work as well, right? And it's very easy to fall into sort of a reactive role rather than a proactive role. And you know what I would argue there is that is the beginning of the decline, right? If you can't see 6 months out or 12 months out even for your business, and we know why, it's going to hurt your business. If it's not now, it's going to soon, right? And so what I see from a buyer trend is access to more information. Can you integrate these things? Can you please integrate with my current ERP where we're doing inventory management, but something's getting left on the table and I have no idea why. I just see the monthly P&L and there's a big gap there, right? So I see a lot of clients coming to us saying, yes, using software to give me the answers is wonderful, but I need to know what's happening, right? And I think it's very interesting to see that a lot of current investment I see is more along the lines of actionable reporting, tying in, looking for different patterns within their organization that should signal red flags that maybe previously didn't, right? Okay, so Joe, I'd like to switch gears here. There's a lot of people in attendance today that are considering selling their company, obviously, right? And so what should they be looking at if they are considering a sale maybe in the next 12 to 24 months?
I think the first thing they want to make sure is why they're considering the sale in the next 12 to 24 months, right? So there's a lot of talk right now with the new administration, the Biden administration coming in, the tax laws are going to change. And so there's a lot of people who are thinking, I need to sell my business now to avoid taxes, right? And we like to say, don't let the tax tail wag the dog, right? The reality is, in some regards, you might be already too late in the sense that if you wanted to beat any tax increase, the only definitive way for you to do that was if you sold in 2020, right? 2021 is probably your last opportunity, although not guaranteed. It is technically possible that any new tax code that's passed can be made retroactive to January 2021. Is that likely? No, based off of history, because that's just not typically how tax code is applied. There's also the element that the Congress, even though it's a 50-50 split, there are moderate Democrats that may or may not be on board for the new administration's goals. So that's the first thing I want to bring up. Like, a lot of people just think like, oh, this is the time I have to sell. It's probably my last chance for another 4 years, right? The other element is, should you still be selling? Are you ready to sell? And Ben will dive into this a little bit deeper, but you might be on the market for 3 to 6 months. So if you're looking to sell, you probably got about three to 4 months to get yourself organized to go to market. So the timeline is shrinking, and I don't think you want that to be your primary decision, right? If you can get more money in the bank by selling in 2022, even with a higher tax rate, then sell in 2022. Make the business decision. Don't make a tax decision. It's funny, I referenced it earlier, the PPP loans still come into play, right? If you're a smaller business and you have a PPP loan, the SBA did provide a procedural notice for change of ownership in the PPP loan. Can you sell your business if you still have the PPP loan? It's not forgiven and you haven't repaid it back? Yes, there's extra steps. I would highly recommend that if that is your goal, take the steps necessary to have that loan forgiven or repaid so that you don't have to involve the SBA in your transaction. It's just another layer that I think you should avoid in preparing for anything this year. Again, I think that might apply more with the second draw loans, but if you're one of those companies, you want to clear that off your book. It's kind of thought with that though, is like, if you're preparing for your sale too, like you got to talk to everybody. You got to talk to your investment banker. You got to talk to your wealth advisor. You got to talk to your accountant. You got to talk to your attorney. Now's probably not the best time to be a do-it-yourselfer to try and cut costs. But there's a lot of moving parts to sell a business that for most people is a once-in-a-lifetime event. And so I just wouldn't rush it just to beat any tax laws. I would make sure you are prepared for an actual good quality sale.
Thanks, Joe. When you talk about a 3 to 4 month window, that sounds highly improbable that it would be done right in that short amount of time. So Ben, I hear a lot of conversation of selling at peak. Is that the right thing to do? Do you sell after the peak? There's so much hyper focus and possibly fueled by what Joe was just talking about. But I'd like to get your opinion on it.
Yeah, quite frankly, peak performance, or at least having a good year, is what gets a lot of business owners to think about timing for a transaction. If you're going to sell for a multiple on your performance, selling off of a good year is going to get you a better result than an average or a poor year. Joe brought up a great point, though. When going to market, the average time between the day I walk in the door to the day we sign the closing documents is 7 months. You are going to be in market being compared to a forecast that you've presented to potential buyers for 6 months. So being able to sustain the peak is vitally important. Beyond that, you're entering into a new marriage if you plan on staying with the business. And if you as the founder owner do not intend to stay with the business, there will certainly be a transition time and your management team will be staying with the business. So you really want to be setting yourself up for a good long-term relationship and making sure that you're going to be able to sustain that performance as you're getting to know the new owner, at least over that first year, while all the pieces are being put into place and you're working on your new growth plan and putting in those investments to sustain that growth or accelerate that growth. So peak is great, but it can't be a one-time peak. You really want to make sure that you're setting yourself up to sustain the peak.
Thanks, Ben. So let's talk about how a deal goes wrong. We talk about this, 6 month time period, 7 month time period, and we've all seen things happen that you didn't foresee happening, and there's a multiple different reasons why. Let's take a minute and really see, Ben, tell us some of the things that you've seen that really cause a deal to go off the rails.
Yeah, so the absolute number one would be a dramatic drop off in performance while you're either in market or you're in closing negotiations. And this can then be the result of a significant client leaving or a project being canceled or some other dramatic event. The good thing about the current environment that we're in is often part of diligence is contingency planning. What would a down year look like? How the business respond to some catastrophic event? I don't think any business could imagine anything more catastrophic than what we just went through. So a common answer right now, you want to know how we perform, during some hard times? Let's look at 2020.
Right.
Another major cause for deals to stall out is a difference in what the expected performance was versus what it actually is. And this is expressed through a quality of earnings report that is delivered by the buyer. In preparation for that, absolutely, I recommend that any company thinking about going to market, preparing to go to market, engage an outside independent CPA firm to, at minimum, do a review of your books and your accounting policies. Make sure that you're accruing, especially if you're on a cash basis. You want to go through a conversion to accrual basis, and that you're accruing appropriately. That can go all the way up to a sell side Q of E, which is still less than a full blown audit as far as the investment is concerned. And it's good to have that accounting provider on board already familiar with your books, because you will update your books after the marketing process when you're going into final diligence and negotiations with your buyer. And at that point, it's not the right time to be bringing a new accounting firm up to speed. They should already be familiar with how your business operates. And that's an instance where you may think that your business is generating a certain amount of earnings, but after that review, it can be an unsettling surprise to an owner to find out, according to GAAP and the impartial CPAs that were brought in, you are not earning what you thought you are. And now you're in a last minute renegotiation or a retrade with the buyer, which is not the right time to be going through that discussion. We try to save up good information and go into closing negotiations with momentum and good news in order to get buyers to stretch beyond their bid. You definitely don't want to be entering on your heels.
Yeah, it's interesting. I would argue when you mentioned CPAs sort of course correcting what a owner thought they were earning, now you're out of the alpha position, right? And so what I would argue is you're either going to pay now or pay later.
And it's going to be a lot more expensive later.
And it's a lot more expensive later. So I would encourage everyone to make that part of their annual operations.
We talk about this all the time, right? The sell side due diligence, but and you are in market all the time. That's what you do day in and day out. Like realistically, though, how many owners actually get that process done?
Very few before we're engaged, and we stress it and really encourage our clients. Just about 100% of our clients go through that process after we've been engaged, and that has a timeline impact. So the earlier you can have it done, and frankly, if you have a history behind it, so that means many of our clients are going to market with 1 year of reviewed financials. Maybe you can pay for the CPAs to go back another year. But if you make this part of your regular practice today and you go to market years from now, you'll have that history. And really what reporting is about is building confidence in buyers that they can rely on the numbers that they're looking at. So another point that I'd like to make that Ben Wilson referenced is your ERP systems, your CRM, your regular business administrative IT systems. Through diligence, you're going to be asked to run reports to show how your business operates. Mm-hmm. A good practice round, and your investment banker, your attorneys, frankly, your CPAs, if they do transaction work, can walk you through, what are these requests going to be? Do a practice run. See if you really know what your inventory turnover actually is. See if you know how your people are spending their time, how much is on client-oriented work versus admin work. Do you have the level of detail to segment your different revenue streams if they have different gross margin profiles? Even your basic operations. And a big one that I can't stress enough is revenue visibility. So do you know what's coming down the pipeline in a detailed way that you can report on it to substantiate your forecast and your growth potential? For many companies, this may be the first time that they've really looked at their own business in that detail. And just like the accounting review, when you're going into diligence with a buyer, that is not the right time to be doing this analysis for the first time.
And Ben, I would say that gives me pause. If that's the first time you're really looking at your business, right? I personally, I study my own business, right? Because there's always something to learn. There's always new insights. And as your company matures, I would say that you need to be in front of it, right? So let's take a couple looks at it. You mentioned revenue, of course. So, last year when the pandemic hit, one of the first things I looked at was, how can we sustain our current level of revenue, right? How do you avoid that big cliff that a lot of companies had no choice but to fall over, right? And then the second thing is, let's take a look at customer concentration. You don't want to have all of your eggs in one or two baskets, for sure. And then, as it relates to valuation, a buyer is certainly going to see that, right? And so, as you said, going into your ERP and starting to run some of these reports that should give you good insight, and certainly will give insight to the buying profile here. You want to be in front of it, and you want to have a good story to tell about your revenue. This is why we're excited. This is why we're excited about 2021 and 2022, because we see these trends. Show them the information, right? Get them excited about the deal. Okay, great. So, another area to look at here is, what have we learned and what are we currently learning from angel and venture-backed companies? Joe, I think you're perfect to start this one off. Let's hear some of your opinions on this.
It's interesting because the angel and venture back, what I call the entrepreneurial and investment community, is pretty unique, right? And it tends to get a lot of the press locally, right? Such and such company received $5 million in funding, and that's great. The funny part is they have $5 million in funding, and a lot of them are pre-revenue, right? They're not even making money, and I find it interesting in the sense that if you talk to the entrepreneurs in that space, they will view closely held entrepreneurs as not entrepreneurs. I'm not sure why, but vice versa always applies, right? And I think it comes down to bootstrap, or whatever you want to call, or sweat equity, right? The person who built his or her company through their own efforts, slowly over time, maybe 15 years, and put their own capital, their own equity, right? They mortgaged their house. They took all the risk themselves, versus another entrepreneur that receives funding from an outside investor who's taking the risk. Well, what's interesting is I think a lot could be learned from both sides of that coin, right? At the end of the day, they're both sets are entrepreneurs. They're both starting a company. It's more of their background. But what's different with the investor-based company, from day one, and this kind of comes back to Ben's earlier comment, their whole goal is an exit. In once, that's why it's called unicorn. And once in a blue moon, that'll be via an IPO, initial public offering. But that's very rare. In fact, most startups are acquired. And so the investors who put money into these companies, from day one, they are treating it exactly like a business, and they are putting in the structure, and they are making sure that those companies are always in the best position possible to add value to their investment. So from day one, they have an exit plan that can be triggered when appropriate, right? Whenever, ideally, and I don't want to go into the time frames too deep here, but 5 to 6 years after that initial angel investment, that company is acquired. And during that 5 to 6 year period, that company is being structured to be acquired. That always doesn't happen. Obviously, sometimes it goes longer. But I think that tenacity of just knowing your business day in and day out, understanding the value, what drives value, how to increase value, that is something that's looked at all the time from day one. And coming back to Ben Garber, I dare say that would make your life a lot easier, Ben, if that tenacity existed from day one from a lot of the companies you represent.
I mean, to that point, Joe, I wish a lot of the investor-backed companies had the cash management discipline that you see with family-owned businesses.
Sure.
But the point that you're referencing really expresses itself in valuation with regard to growth rate. So something I hear a lot from closely held businesses is, hey, I'm at 20 million of revenue, and that startup, they're only 2 years old. I have a much longer track record. Well, the long track record to get to the same point results in a lower growth rate. And growth rate is something that we're seeing really driving valuation multiples. One peel of the onion beyond that, though, and you'll hear a lot about this, is scalability. So in all lines of business, professional services, so people-based businesses where the assets used to go up and down elevators, and manufacturing and technology businesses, a large focus of investors is on growth and how are we going to grow this company, and how much money are we going to have to invest to be able to do it. When you start your business with growth and an exit in money, there's a lot of attention being paid to what types of investments can we make so that as we grow, our costs don't grow completely in line with it. So you want to be able to see a roadmap where as you grow the businesses, your margins will expand. And if you combine with a business and have enough outcome, revenues grow really fast, the capacity of the business is going to be able to support that. And that's a big, lesson I think that we can learn from the investor-backed companies that start with that orientation from day one.
Yeah, I would agree. And then also, one of the things that I've seen is a reluctance to invest in your own company, right? And maybe it's out of fear of the unknown. Maybe it's out of fear of having to explain to a future buyer why you invested in your company at this time, right? As a technologist, I can tell you that I've seen many examples of companies that are successful despite their investment in technology, right? And that's fine. And especially with the family-owned businesses, I do set up a fair amount. But that's not the right target. The target is, what could you be had you invested, right? And so, especially when you start talking about potentially doing a deal, say in 12 to 24 months, I see owners and leaders have a reluctance to invest. And I would argue that that reluctance, and maybe that savings even, is going to come very apparent when you start talking to a buyer. So, no, we don't need to invest in this ERP system because, first of all, it sounds like a 6-month project, and it's an investment from my side. And we have Excel. We've run off of Excel for 10 years, and it's just fine. But the moment the buyer starts asking tough questions, but operational questions, the ones that you should be able to answer, it's going to be a problem. And now again, we talked earlier about kind of getting out of the alpha role, and now you're taking a backseat to the buyer, who's now dictating to you how you need to operate your business. That's going to affect valuation.
Ben Wilson, I'm really glad that you brought that up because if a buyer thinks that certain investments need to be made, deferred maintenance is the easiest one to wrap your head around. They're going to layer those costs on top of your forecast because that money is still going to have to be spent. And at that point, it's going to be coming out of their pocket. The other impact is on your narrative. So selling, whether you're selling a product and service for your company or you're selling a company in the M&A markets, is storytelling. And to be able to say, oh, we know we would make more money if we hired professional salespeople. We just didn't prioritize that investment. It falls a little flat. And when we talk about scalability, even bringing on salespeople, often, CEO stands for salesperson, but you want to see a little depth of the bench and some scalability of the team. So that these principles apply to human investments as well.
I think that's pretty interesting. So if I was looking to acquire a certain company and they told me we could have been much better, but I didn't invest, I immediately have a problem with the entire conversation. Because what we talked about, the sort of marriage that happens for the few years after the deal is done, right? Is that an indication of how you're going to work over the next couple of years? Is it going to be worse, right? Or I I look at investing in your company as something you should constantly be doing, right? You should constantly be looking for growth. And I think that focus is going to appeal. First of all, that narrative is going to appeal to the buyer, right? They want to know they're buying something that's going to be bigger than it is now, right? That if 2020 was if you were fortunate enough to peak in 2020, and it wasn't because of selling masks or otherwise, then I would say I want to buy a company that's going to go past their peak, maybe a couple of tweaks, right? And I think it's really interesting that you mentioned that as part of the transaction, the buyer will put that cost back onto the forecast. So again, we return to a situation where it's pay now or pay later. You're going to pay either way because it has to be a good business, right? It has to be something buyable, right? Nobody buys, well, it's less likely to buy a company or your company gets purchased if you let things dwindle, or if you spent the last year sort of crossing your fingers that all of this would magically go away, and it hasn't, by the way. So I find that really interesting. One topic that is somewhat related here, I think if you are going down the road of a transaction and you're looking to sell your company, let's talk about operational decisions that might sting you if the deal doesn't happen. We talked earlier about deals upending. It's for some reason. There's many different reasons why a deal doesn't get done. So if I'm selling my company to Joe and I cut all of my sales staff and anyone that doesn't generate revenue for the company just to get that P&L super lean, right? And it would make it look really interesting, right? Cut any real estate investments, things like that. And I tie it up with a nice bow to Joe, and Joe says no for whatever reason. It's possible I have damaged my company for a few years, right? Just by trying to what someone might call streamline their operating expenses. Any thoughts on that, Ben?
So I get this question in a myriad of different varieties and flavors. And if I could leave the audience with one rule of thumb here in response to that, it's that the right decision for your business today or ownership is the right decision for your business tomorrow under new ownership. So continue to operate your business with the long-term view as you normally would, and do not let the possibility of a transaction cause irrational decision-making. What's best for your business today is what's best for your business tomorrow, and that's what buyers are interested in.
It's a great conversation.
I would just add real quick though too, as Ben knows, as he referenced earlier, the buyer is going to get a quality of earnings, right? And so all those cuts that you made, they're going to come to light anyhow at the end when the other accounting firm comes in and does their buy-side due diligence. And the buyer is going to bring it up.
Absolutely.
You're going to have to answer it.
Absolutely. I mean, they're armed with their own criteria for negotiation, right? And I think it's the current owner leader that needs to get in front of those conversations. Joe and Ben, this has been a great conversation. We're going to transition now to the live Q&A session. For those attending, please join us for the after session. Thank you.